Pretty quiet now. Hello, this is Patrick. Welcome to Chart Built Wealth, profitable investing with technical analysis. Well, it's Sunday evening. Just got done playing a couple hours of pickleball, so I am totally relaxed. But I wanted to cover my current buy recommendations. There's six of them, and so let's get into it. This is not a buy or sell recommendation. I just wanted to take a look at this is a Dow. And you can see since 2022, we have a converging ending diagonal pattern, which is a bearish pattern found at according to Edwards and McGee back in, I believe that was the 50s, ending diagonals. They were kind of the technical gurus and kind of the Bible. And ending diagonals are found at the end of major market moves. And, we have all the touches we need, A, B, C, D, E. So, and you can see all these higher highs. We got really lower highs on our relative strength index, flashing a caution sign. Beware a change of trend, but you can see that this has gone on for, 6 months, this last higher high. So, I'm cognizant of that, and you should be too. But so I wanted to give that as a backdrop. So I'm trying to find things that will not give us a lot of risk and hopefully some reward and allow us to participate in a stretched market here. So the first buy recommendation that I've had that I'm going to cover is GSG, the iShares Commodity Index. This is a heavy energy laden commodity, broad-based commodity index. And I'm going to show you the breakdown of that. So in order for this to go, we need oil and uh, natural gas to participate. And they have not so far. And there's a lot of signs short term that it could edge down here a little bit. So, but I'm going to follow the chart. I got money in here. Again, every time that I see an up day or an up week, I'm selling into that strength. And when I get a down week or a down day or whatever, I'm buying. So here's the big pattern. This is the bullish pattern. A, B, C, D, E. You got a symmetrical triangle, 1, 2, 3 years in the making. So it's a big pattern and should matter. So a lot bigger the pattern, the more uh, potentially profitable they are. And with it's tried to break out here a few times, and we have another small consolidated triangle right here. What I like about last week, even with oil prices going down, they rebounded, even crude oil did in the last couple of days, and we have a small bullish hammer here, meaning that people were buying on the lows like I was. And so if we can get going here, the price projection based on this pattern by measuring the base of the triangle and projecting that distance upward is about $31 or about 35% higher than where we're at. Here's where I recommended. It's kind of gone nowhere. At least it hasn't gone down. And so that is my first buy recommendation. The breakdown of that index is 70% energy. So at some point, energy's got to go. Every hedge fund, trend follower, that's what they basically do. When something goes up, after a year or two, they jump on it and they ride it until it changes. But of course, they miss a lot at the beginning. So we want to identify as a market technician trends at an early stage and then stay with those trends until they change. So we got 70% energy, we got 16% agricultural, we got 7% industrial metals, copper, aluminum. We got livestock. We've got precious metals, a small amount. And so, precious metals has been the big winner, and I've been bullish on gold, silver, uh, copper, platinum, made money in all those for people that have listened to me here. So, but I think hopefully there's going to be a handoff to energy. And if that happens, then this will do really, really well. Why would it do well? Well, look, we're going into the bullish seasonality. You don't want to own oil. This is just a tendency. That's all seasonality is. It's not a, you know, it's going to go down during July to early December because of seasonality, but it's a tendency. You want to have that in your favor. Right now, energy should be bottoming, should go up through the end of the year and then get a little consolidation before it really takes off. So again, if crude oil does well, then GSG will do very well. And if we look at the commercials, this is the uh, futures report, which breaks down into three groups: the commercials, the big boys. These are people in the business. This is the Chevrons. This is the Exxons. This is the people that know the industry. And then you have the trend followers, the hedge funds who get in late and get out late. And then you got the small speculators that are usually wrong, but you have the big boys, the big commercials. Look at how bullish they are. This is the most bullish they've been, probably going back to, I believe it's 2016. So what do they know that we don't know? I don't know, but I know they're giving money to get information and to know what their oil is worth. So hopefully GSG is a beneficiary of this, and I'm bullish on it. The second buy recommendation has been Chevron. This has been very dicey. It has not been able to get going. It looks a lot like GSG. The overall commodity index that's heavily weighted towards energy, and you've got a 1, 2, 3+ year consolidation. It's tried to break out, couldn't, and here we are. We're pretty close to our stop at 147.5. Again, I want to see a weekly close below that to get me out. These are tedious times for a couple of these buy recommendations. But the patterns, if we can hold, they could be very, very profitable. And so Chevron, the second buy recommendation, this also plays into energy, but it also has minerals, these minerals that the U.S. wants, as far as Venezuela goes. It's not all about oil, it's about minerals, it's about all these things that we lack. Um, and so Brazil, here's a huge consolidation. Again, 1, 2, 3, 4, 5 years in the making, and it broke out. We didn't chase, we waited for a retest of that breakout. The price projection is, what does that say? 51. So we're at 31. It's a 50% potential increase. And we've got a retest right now. We've come back and retested that breakout. I think it's a good time to own Brazil. This is a short-term chart. I'm also cognizant of the bearish implications on a 6 weeks basis. If it breaks much below 30 and a half, I'll go to neutral for a while and then look to get back involved. But I'm bullish on Brazil. The opportunity is huge, and uh, I think you should own it. And this is a point and figure chart. This is the purest supply. This does not have the subjectivity of the charts that I draw. This is truly just supply and demand. And so as it broke out of this bearish trend line here, you can see it went it skyrocketed. It went from 23 to 33 in a very short period of time. Again, we didn't chase that. It's pulled back a little bit, and we have a new bullish trend line, and the price projection based on the point and figure chart is 55, which is $24 higher, which is let's say it's 45%. So again, bullish on Brazil, but a lot of these things are tied into oil and energy. So we're going to keep a monitor on that and somewhat of a short lease on so that we aren't overweighted in one area. So here was my other recent buy recommendation besides Brazil, and that is the First Trust Health ETF on healthcare. And so here, after peaking back in 2021 at 126 and then trading down to 90 and now being up to 115 and breaking this neckline here of these highs, we have a bullish inverse head and shoulders pattern with the left shoulder, the head, the right shoulder, the neckline right there at, let's call it 114. The price projection by measuring the bottom of the head and the neckline and projecting that distance upward is 140. So we're, I don't know, 21, 22% potential upside. And so who knows what's going to happen with healthcare with the new administration, actually basically no healthcare at this point. Who knows what announcement will come out? But the chart says to own this. Let's take a closer look here. And here's the bullish inverse head and shoulders pattern. Left shoulder, head, right shoulder, neckline. We have two bullish hammers here where prices started the week up here around what is that? 116, traded down to 113 intra-week, closed the week back up. That shows you that buyers were coming in. And then last week, the same thing happened. So, I'm giving it a little bit of space here, but I think the reward to risk here is really, really good. All right, next buy recommendation is shorting treasuries. So when treasury prices go down, bond yields go up. And rates have been in a rapid have gone up rapidly since 2020. Look at this. So if you could see this chart back to 1980, yields have gone down. This has been a bullish channel, meaning that yields have gone down continuously until 2020. And that's what spurred the stock market all those years. Rates go down, bond prices go up, stock prices go up, inflation is low, and then in 2020, this thing shot out of a cannon. So we've gone from a declining interest rate environment to one. This is a 30-year Treasury yield. So this is the longest Treasury, and this is the interest rate that it pays you. And you can see this is a clear change of trend in interest rates. The yield had gotten down to less than 1%. Now we're up to 5%. And after this big run, we've gotten a sideways consolidation. That's a sign of strength, suggesting higher yields to come. And so if you have any debt or you own a home and you have a mortgage and you have an adjustable rate mortgage, you want to be really careful here because this could explode to the upside, and that's what I'm expecting, which I don't think anybody else is, because they're like, well, wait a minute, the Fed's going to cut interest rates. The Fed is going to cut 1 to 3 month Treasury bills, and that is going to be inflationary on the long end of the curve. So cutting short-term rates is going to be inflationary, making long-term bond yields go up. Okay. I think that's important to know. So let's take a closer look here. This is the 20-year. That's the only thing they have publicly traded besides futures. And I don't like doing futures with leverage and all the added risk of that. So I'm buying an inverse 20-year Treasury ETF. So if yields go up, this is going to go up in value. And so this is when I initiated, and I'm expecting initially from the small inverse head and shoulders pattern bullish, left shoulder head, right shoulder, that will get up to 120. What is that? 126, which is not a huge move, but for your bond portfolio. So if you're a traditional investor and you got 60% in stocks and 40% in bonds, and 40% of your portfolio goes down, that's going to hurt you. So I'm suggesting with your bond portfolio to protect yourself. If you've got a bunch of bonds out there that are paying you coupons and all that, you might want to hedge that a little bit with this vehicle. So again, I think the potential here is really, really big, and I have quite a bit of money personally in this, and I hope it works. Last but not least, corn. So this is something that uh, nobody would expect to go up with all the tariffs and the farmers yelling and screaming, rightfully so. And but sometimes when the news is really, really bad, that's when market technicians, when we look at uh, bullishness, get down into the single digits. So I don't get these on corn, but when I get a 5% bullishness on something, stock market, bond market, whatever it is, that's the time to buy. And so for big major market moves, this is multi-year duration. So what I see when I look at this chart is a clear change of trend from down to up. We got a five-wave advance, Elliott wave theory, trends or cycles go in waves of five. We got five telling us the trend is up. We got a three-wave decline telling us we just corrected. I believe the low was a couple of months ago. And if that's true, we should be entering the third wave advance, which are the most profitable and the biggest. I always try to identify third waves because you make money quicker and the moves are really bigger. And you can see as we hit these lower lows here, we hit higher lows here, and that's flashing a caution sign, beware, a change of trend is coming. And that is, in this case, from down to up. And this is just a short-term chart. So here was our little bullish channel going up from the bottom from here. And I'm like, oh no, what's going on? We're breaking our bullish channel, and it looks like we're consolidating here after this move. And so after maybe a little bit more consolidation, we'll get another up thrust. So hanging in there with corn too. Why would I want to own corn too? We want to look at seasonality, especially with grains and the commodity market. They really, seasonality has a bigger impact on prices. And you can see you definitely don't want to own grains from June to the end of September. But since early October, this is when you definitely want to own them, and we have. And so through the end of the year, we should get some higher prices and then a little bit of consolidation in January before we really take off again. Thank you for watching Chart Built Wealth, profitable investing with technical analysis. Please like and subscribe. Tell your friends, neighbors, family.